Your point transaction is just about finished. You'll be signing your documents soon, and the home equity investment funds will be making their way from the escrow company or closing agent to your bank or wherever you decide to send the money. Before that, however, we want you to know what to expect in the signing appointment. We also want to make sure that you understand what you're signing. While you're watching this, feel free to stop the video and make note of any questions you may have. If you decide to have a conversation with your point closer, they'll be able to answer all of your questions. Before we get started, you will want to open the email you received from Point that contains your document package. As we walk through some of the more important passages, you'll be able to review your own documents. And again, please stop the video at any time and write down any questions that come up. Your point closer will be happy to provide the answers. Your signing appointment will be with a licensed notary. The notary will not be able to answer any questions you may have about the documents or the home equity investment. There are a couple of your documents that you will need for the signing appointment. You will need a valid, unexpired form of identification. This can be your state-issued driver's license or identification card or your passport. Note that it cannot be expired on the date of signing. If you would like to have the funds wired to your bank account, you will need to provide a voided check with your account number and your bank's routing number. You will complete a form with this information, which will instruct the title or escrow company to wire the funds. If you do not want the funds wired, you can indicate that you want them to provide you with a check via special courier. Point observes a 3-day rescission period, which typically starts the day after the effective date of your point option agreement. During this rescission period, you have the opportunity to cancel should you decide not to move forward with the transaction for any reason. The rescission period exists so that you can have extra time to review the closing documents, even after you've signed. The days counted in the rescission period do not include Sundays and holidays. If you do not notify us that you want to cancel the transaction during the rescission period, Point will fund the home equity investment. When you are signing your documents, one of the forms that the notary will have is the Notice of Right to Cancel. It will look like this. In the top portion of the Notice of Right to Cancel document, you will see the 3 events that determine when the 3-day rescission period begins. The rescission period begins on the last of the 3 events shown. The date of closing of the transaction is the day that you sign the point option agreement. The date that a homeowner signs the agreement is typically the last of those 3 events, so that is usually the date when the rescission period begins. Below that is the section titled How to Cancel. Note that if you do decide to cancel the transaction, it must be done in writing. This section provides the instructions for canceling the transaction should you wish to do so. It is also important to note that this portion of the How to Cancel section will indicate the last day that you can cancel your transaction. You must provide your signed and dated intent to cancel no later than midnight of that date or postmarked by that date. Please feel free to contact your point closer if you have any questions about the rescission period or the timing of funding your home equity investment. In the email you received from Point, there are 6 or 7 attached documents. First, take a moment to locate the closing disclosure document attached to the email. The day after the rescission period has passed, Point begins the funding process and wires the investment funds to the escrow account with the title company. The closing disclosure shows the disbursement date for your funds in the upper left-hand corner of the first page. As mentioned previously, you can have the title company wire your funds to your bank account or send you a check by special courier. Also, it's important to know that if you are having your funds wired to your bank account, the wire will be sent on your disbursement date from the Pacific time zone. But the deposit may not post or show up in your bank account on the same day. Depending on your bank's procedures and your time zone, this can affect how many days until the funds are available from your bank. If there are creditors being paid off, they will be listed in the closing disclosure and the point option agreement.
For lien payoffs or property taxes, the title company will pay these debts directly to the creditor or tax authority. For courtesy payments, such as paying your mortgage current, the title company will make checks out to those creditors and will send them to you by special courier. You will be responsible for sending those checks to the creditors. When mailing the checks to the creditors, we recommend that you attach a copy of your account statement to the creditor's check so that your account gets properly credited. For funding, The title company will record the appropriate documents with your county's official records office.
Depending on your state and/or county, the title company will send you your funds either before or after these documents have been recorded with the county. Let's take a closer look at the closing disclosure. On the first page of the disclosure, the top portion of the form shows information that identifies the transaction, such as your name and address, the date the disclosure was issued, and the disbursement or funding date. Below that, the Option Terms section lists the specific terms of your home equity investment agreement with Point. The numbers you see on your closing disclosure should be the same as the numbers shown in your final offer from Point. At the bottom of the first page is the closing summary. This brief section shows the amount of closing or transaction costs paid by you, the homeowner. It also shows the amount of money that you will receive after the closing costs have been taken out of the investment funds. This way, you don't need to send money for the closing costs to the escrow company or closing agent. The remaining pages of the closing disclosure show more details about the closing costs, about any debts or accounts the investment might be paying, how the net cash to you is calculated, and other items about the transaction. You will need to sign and date this document. Also, keep the closing disclosure handy for the remainder of this video. We'll be referring back to it later. Next, let's take a brief look at the security instrument. Some states use a mortgage and others use a deed of trust. Depending on where you're located, those documents will look something like this. Pause the video while you find it in your documents. Similar to the closing disclosure, the security instrument is the same format used in home loan transactions. Whether it's a mortgage or a deed of trust, this is the document that secures the Point option agreement to your property, just like it would secure a home loan to your property. You'll find identifying information in the first few pages of the document, like your name, the property address, but everything else will be the same language that is used when obtaining a home loan. This document will be notarized and recorded with the county. You may have noticed this document included in your email, the Consent of Spouse form. We include this form in all of our document packages, even if it doesn't pertain to your situation. If you don't have a spouse, then you won't need to do anything with that form. However, if you do have a spouse and they are not being included in the transaction, your spouse will need to sign the Consent of Spouse form. This is also a notarized document.
Please note that in some states, if you are married and own your home in just your name, your spouse will need to sign the security instrument and notice of right to cancel as well. Please reach out to your closer if you have any questions regarding spousal signature requirements.
So now, let's take a close look at the document that spells out the actual terms of your Point home equity investment, the Point Option Purchase Agreement. The Point Option Purchase Agreement is the contract between you as the homeowner and Point. It's a 26-page document, and at the very top, it will say Point Digital Finance Option Purchase Agreement. Now, we won't go into every line of the agreement, but we do want to make sure that you see and understand some of the important aspects. We'll take a look at each of the 7 sections of the agreement, and I'll give you a summary of what each section covers. Pause the video and take a moment to open the Point Option Agreement. Again, please remember to write down any questions you may have about what you see in the agreement so that you can ask your Point closer for answers or clarification.
The first page of the agreement shows us Section 1, the terms used in the option agreement. The table of terms shows us the wording of the term, its definition, and more importantly, your specific information related to that term. For example, the very first term in the table is the investment amount. The amount shown in the column titled Owner's Information should show the amount of your home equity investment. The key figures in the third column in this table from your transaction are the investment amount, which is the amount of your home equity investment, your HEI option percentage, your appreciation starting value, and the homeowner protection cap, which you've probably heard simply as the cap. These are all very important because these figures will be used when you're ready to repay Point. You may recall from conversations with your Point account manager that when you want to repay Point, the repayment amount is the lesser of 2 figures, including the amount of the HEI investment. The first figure is the amount of the appreciation in your home above the appreciation starting value. That dollar amount is multiplied by the HEI percentage. This is the first of the 2 figures. The second figure is the investment amount compounded monthly by the Point homeowner protection cap. Whichever of these two figures is less gets added to the investment amount, and that is the repayment amount. Typically, the sooner that a homeowner repays Point, the cap repayment amount is the lesser of the two. These two figures shown in your Point option agreement, the exercise payment and the option consideration, are related. They come into play if, for some reason, a homeowner is unable to keep their agreement or defaults on the agreement.
Here's an example. Let's say a homeowner reaches the end of their 30-year term in the agreement and they are unable to repay Point. Now, if this were a mortgage and the homeowner defaulted on the loan agreement, the bank would simply foreclose and sell the house to get paid off. With Point, it's a little different. What Point would do under this scenario would be to send the homeowner that exercise payment. This basically means that Point is exercising their option to purchase a portion of the home. When that occurs, Point would then actually own a percentage of the property, and we would work with the homeowner to sell the property so that Point would be repaid for the investment. In reality, it is highly unlikely that a homeowner would get into this situation because they would typically refinance the property or sell it, and Point would be repaid. Also, if a homeowner does fall into default and can cure that default, Point would not need to exercise the option. Nevertheless, we'll go over the exercise process and some examples of default in a few moments. The amount of acknowledged pre-existing loans will show the total balance of the loan or loans recorded against the property. Note that this figure will likely not be exact, as it is just a snapshot of the balances during the underwriting process. The expiration date shows the end of the 30-year term of Point's option agreement with you, the homeowner. Legal form of ownership of property shows how you currently hold title to the property, such as married, unmarried, owned with other people, or in a trust. Owner-occupied versus non-owner-occupied indicates if you use the property as your residence or second home, or if you rent it out to tenants. The property type field shows how the property is classified, such as a condominium or a single-family residence. Next, let's move on to Section 2. Earlier, we talked a bit about the option exercise. Let's look at this a little more closely. Section 2, which starts around the bottom of page 3 and goes into page 4, talks about what happens if a homeowner wanted to repay Point by selling their home or doing a cash-out refinance of their home mortgage, or if a homeowner was in default on the agreement and Point had to exercise their option and work with that homeowner to sell the property. If the homeowner is refinancing their existing mortgage and taking out additional cash from their equity in order to repay Point, we ask that the homeowner provide us with the appraisal being used in the refinance transaction. If the homeowner wanted to sell the property and repay Point, we ask that the homeowner notify us of their intent to sell the property, which is usually done by email, and that you are selling it at market value. We also ask that the homeowner provide the fully signed sale contract for the property. In some cases, it may be a situation where Point believes the home is being sold for less than the current market value. In some cases, this isn't a problem. For instance, if the homeowner was selling the property to a family member or close friend at a discounted price, that's fine. However, we would require that an appraisal be done on the property so the actual market value can be determined. We would then use that value to determine the payoff amount to Point. Scroll down to Section 2.2, Owner Option Repurchase or Point Option Exercise as of Expiration Date. This portion of Section 2 talks about what happens when a homeowner goes into default. Point will send the homeowner a 30-day notice so that they can cure or fix the default within that 30-day time frame. If the homeowner is unable to cure that default within that initial 30 days, Point then issues a 90-day notice letting the homeowner know that we will exercise our option unless the homeowner can cure the default situation. That's 120 days that the homeowner has to fix their default situation. Even after that initial 120-day period, Point still can't exercise their option for an additional 30 days. The point of all this is that exercising Point's option doesn't happen overnight. We would want to work with the homeowner and give them as much time as possible to cure a default situation instead of exercising our option. Remember, Point only succeeds when the homeowner succeeds. Section 3 talks about the exercise of Point's option. It starts at the bottom of page 8 and continues into page 9. What this section means is that Point actually reserves the right not to exercise their option, not send out the exercise payment to the homeowner, and to instead just let the investment lapse. For example, let's say the homeowner had a first mortgage and that mortgage went into foreclosure, and the property was going to be sold at a much lower value during the foreclosure proceedings. Most likely, there wouldn't be anything for Point to recover on its investment. Most of the sale proceeds from the foreclosure would go towards paying off that first mortgage holder. So if that were the case, Point would simply let the foreclosure proceedings take place. We would remove our lien from the title to the property and no longer collect on that investment. Section 4 of the agreement starts on the bottom half of page 9 and continues into page 10. This section covers our promises or covenants between the homeowner and Point. It's actually rather straightforward. It states that the homeowner needs to maintain the property insurance and not let it lapse, as well as keeping the property taxes current and not letting those items become delinquent. These two items in particular are considered events of default with Point. However, we definitely understand that some life events can happen that are out of a homeowner's control. So this part of the agreement allows Point to step in when necessary and keep those items current. For example, let's say we have a homeowner whose insurance lapses and they're unable to make that payment to reinstate the insurance policy. Point has a right, but not an obligation, to make that payment on behalf of the homeowner, which is called a preservation payment. It's also important to understand that if Point were to make that preservation payment for the homeowner is obligated to pay the amount of the preservation payment back to Point immediately. Additionally, Point can charge as much as 8% on the payment amount until we're repaid. So should Point want to make the preservation payment, it is in the homeowner's best interest to repay it as quickly as possible. It's another way that Point tries to help avoid events of default, because again, ideally, we actually do not want to have to exercise our options to get repaid. If we can possibly make a payment for a homeowner's insurance or property taxes to avoid foreclosure or exercising our option, we would prefer to do that instead. Section 5 talks about what the homeowner has represented to Point as true and correct. It basically says that everything the homeowner has told us is true, and there isn't anything that Point doesn't know about. For example, you've indicated that there are no pending lawsuits, no foreclosure actions have started, there are no other claims to the property by third parties, there aren't any environmental hazards, zoning violations, things of this nature that we've not been made aware of by the homeowner or from an appraisal or title report. Section 6 addresses defaults and remedies for default. We previously mentioned two events of default. One is allowing the property insurance to lapse, and the other is when the property taxes become delinquent. Let's look at a few more default situations. Declaring bankruptcy is considered an act of default. Homeowners should make sure that they do not declare bankruptcy during the term of the agreement. Transferring title or attempting to transfer title to the property without notifying Point. If a homeowner does intend to make any changes to the title of their home, for example, they want to add or remove someone from the title or put it into a trust, the homeowner needs to be sure that Point is notified first, well before the change is made. This allows Point to request any documentation we may need pertaining to the change. For example, if title to the property is being transferred into a trust, we would need to see a copy of the trust agreement. Obtaining any senior liens or government finance liens which would be recorded ahead of or above Point's lien position on the property. This is considered an act of default. So, if a homeowner wanted to obtain a loan such as a HERO or PACE loan for home improvements, for example, the homeowner would first need to repay Point. Not maintaining the property is an act of default. And what we're referring to here are primarily structural items, such as keeping the roof in good condition, fixing any leaks, and doing any repairs to the property in a timely and professional manner. Related to maintaining the property is keeping the home vacant for more than 2 years. This is related to keeping the property maintained because no one would be living in the property and maintaining it for that amount of time, so it could adversely affect the value. This act of default is generally more important when the property is either a rental home or second home, where its upkeep could potentially be greatly affected due to it being vacant. Another event of default is leasing or renting the property when the lease or rental agreement extends beyond the expiration date of the Point option agreement. This certainly pertains to rental properties, but can also occur if a homeowner decides at some point to rent out the residence and live elsewhere. That's certainly fine, but the homeowner would want to make sure that the rental agreement does not extend beyond the expiration date of your Point option agreement. For example, if a homeowner had 2 years left on their Point option agreement, they would not want to enter into a rental agreement with a tenant for more than 2 years. The last section of the agreement is Section 7, and it addresses a few miscellaneous items. One in particular is that the point option agreement is binding to you, but also to your heirs. Obviously, while we hope nothing bad happens to our homeowners, if the homeowner were to pass away and the property was inherited, the point option agreement would still be binding, and we would have a valid lien against the property. Point would need to be repaid under the same terms that were given to our homeowner. And finally, after your Point home equity investment is funded and you've received your cash, Point has partnered with a company that services or coordinates the repayment of the investment when that time comes. That company is RoundPoint. We should also mention that Point and RoundPoint are actually two separate companies. We just happen to have similar names. You'll recall that you needed to add RoundPoint to your homeowner's insurance policy. After the investment funds, you'll receive a welcome letter from them within about 10 to 14 days. The letter will include all of your account information and their contact information. You'll want to keep that letter with your important documents so that when you're ready to repay the investment, you'll have all of that information available. Of course, you're welcome to contact Point directly if you like, and we'll be happy to assist with the payoff as well. When you're ready to repay Point, RoundPoint will be your first point of contact. We hope this video has been helpful and informative. Remember, if you would still like to have a conversation with your Point closer, please don't hesitate to reach out and let us know. Your Point closer is happy to answer any questions you may have. Thank you for watching, and thank you for choosing Point.